Okay, good morning and welcome to the Minervini Private Access Trading Room. I'm Bob Weissman. If you can raise your hand to let me know that you're hearing me loud and clear. Hope everybody had a good weekend and do see a lot of hands here. Great. Let's also welcome Mark Ritchie into the room. Good morning, Mark.
Morning, Bob. Morning, everybody.
And if you could just raise your hand real quick, let us know that you're hearing Mark loud and clear. Okay, great. And then let's get started with today's session with Mark Minervini. Good morning, Mark.
Okay, good morning, everyone. Hope everyone had a great weekend. Just starting off, I know at 11 o'clock I didn't see any major fireworks, but I know the Fed was coming out with one-year inflation expectations, and that also ties into going into Friday. There'll be University of Michigan inflation expectations, but in between there on Wednesday we've got the CPI, which is the big number everybody's looking at. Also on Wednesday you get the FOMC meeting minutes, and then on Thursday you got core PPI. So those inflation statistics are definitely going to create volatility in the market, and I think that's where we gotta, be careful going into that report. As you know, of course, I shorted the Dow. Like I said, it could turn into basically a default hedge. It's just a position with a stop that I think is relative to the potential reward is a good risk reward play at this point. Personally, I shorted it as well, and I actually doubled my position and went overweight here this morning, but with a very, very tight stop of today's high, which is a very good chance I get stopped out. Sometimes it takes me 2, 3, sometimes 4 or 5 tries to get it right. But I'll take on these bigger positions with really, really, really tight stops when I go overweight. So that's something, just full disclosure, just sharing with you. I didn't put it out as official, just too tight on the stop. I don't want to be whipping things around here so quickly. But again, if we rally here, maybe get a little rally back into this range. That's where I shorted as we rally back into that outside day, the break below the 50. The Dow seems to be the weakest here. It would make sense even if you haven't going short. If you want to short here, it's relatively low risk of course, for holding overnight. It's an index, not going to gap 20% on you against you, and also the stop, the all-time high here is not very far away. What else? What else? Just individual stocks. You can see the focus list. There's not many names, and the quality is just gotten lower and lower. I did put Netflix on because it's just holding up so well. Fundamentally, I like Netflix. If there's there's a lot of things going on fundamentally that are really solid for Netflix. This BPMC has got a pretty nice base. It's still building this right side here. Had that pullback buy. Of course, I'd be looking to add to this if it can. Let me show you a little more of the chart. That's a pretty nice base, along with something like the DUOL, which is also a pretty nice base here. And I was looking for it to tighten up. Again, the market getting a little squirrely here, has it coming off a bit, but this is still acting very normal. If we can tighten up here, you get a little low cheat. I definitely wouldn't get aggressive at that point going into the supply, especially with the market being a little heavy here, but certainly be watching this to hold and set up. A couple other names. The APPF is one that again pulled back here. You'd be looking for some more consolidation here around a low cheat and maybe build out a right side. Most of the names now need to build out right sides. Coin again, Bitcoin, as I pointed out, again coming in and whammo real quick. Let me just bring up Bitcoin. These big gaps you see, there's demand there. When this pulls back, boom, that buying comes in. I don't expect that to stop anytime soon. I do expect there to be volatility, and it's not maybe the easiest hold, but I think there's still a lot of demand there. And of course, because of that, coin becomes this power play type setup here becomes something that I think we should also consider. That's about it. I think not much more to talk about. We've got a very tight stop overall on open positions. You see I've improved the worst case scenario on many stocks, moving stops to break even and cinching stocks up. We've got a couple gains that are 8%, 6%, and a few losses that are fractional. So still, holding in there as far as the open positions, but we got knocked out of a lot of names, and there's really not many on focus lists. So there's absolutely no reason to get aggressive here. So let's get to your questions. Oh, lastly, sentiment. I covered sentiment. I haven't shown the investors' intelligence numbers in quite a while because there wasn't much to say. But now when it gets above 60, starts getting to that 60% bulls level, especially when the bears are low teens or mid, in the teens, that is definitely something that is a red flag. It's a big red flag when you start getting 4-to-1 bulls to bears and bulls are above 60%. That's where I start looking to look for a spot to short the indexes, and I get very, very tight on my stops and expect an upturn in volatility, especially when volatility has been down for so long. And we're now seeing it turn up. This is where we've got to look for that potential volatility to come back into the market. With that said, let's see what you guys have for questions.
Sure.
And I don't know if you did you put a post that we were going live here, because I don't know if I saw that, but you might want to do that.
Okay, we'll do.
Just to remind people that we're having the Q&A.
Sure. The first question coming from Alan is, he set a buy stop on GIC
Yep.
this morning at 45.70 with a
Yep.
stop of 5%. From the weekly chart, it looks like it will break the big base since 2018. Could you comment on this trading plan?
Yeah, I mean, it looks, I don't know much about this one, so I don't really know much about it fundamentally, but if we just look at where that pivot is, it's obviously that's where the majority of the action has occurred. You only traded above this level on a couple days, 3 days or so. So we do want to punch through there. Again, that, when you look at the market environment right now, I'm cautious, right? We're on red on the stem, which is an indication that trades are not working well enough for us to, be considering taking big risk at this point. So, if the market was doing great, yeah, this is a no-brainer. With this market, I would expect a lot of these to break out and then squat and fail and reverse and cause you a lot of aggravation. So I'd say, it looks fine, from a standpoint of the chart. Tried to break out over here. You got a little reset now. I don't know how far it is from this low. Let's see if it breaks down here. Yeah, it's about 6% or so from this low. I would want that low to hold, of course. Definitely this low, of course. So yeah, I mean, I think it looks okay. But again, I'm being very selective at this point. I wouldn't get involved in anything too heavily right now, especially until we see what happens with how the reaction is to the CPI on Wednesday. And even a couple of days after, because sometimes you get a delayed effect. You'll rally first on a report like the inflation report, and then as it digests over a couple of days, that's where you get that reversal, and it's sort of a sucker's rally.
Question coming from Jesse asking about Coinbase. We posted the pullback by triggering on 4.3. He would like to know, though, if he were to buy it at 255 and a stop loss of 235, if that would be a good strategy.
Okay, so what's the day? The prices aren't going to do me any good. Buy it on what day?
Well, we posted on the platform, it triggered a pullback buy on 4.3.
Yes.
But that price is much lower than what he's asking now, as if it would be okay to buy it at 255 with a stop loss of 235.
So, but 255, again, the high today is 261. So 250 and the low is 249. So where does 255 come in? Are we looking at maybe the previous days? Let me see. No.
Yeah.
I don't understand where 255 comes in. So, it's better to ask me a question and say, on this day, but I don't know where 255 comes in. So I'm not looking to buy this just yet. I mean, it could just take off here. I mean, you certainly can play it above 260, 150. I mean, you can even play it as it started coming through the previous day's high here this morning and play this, additional pullback buy, if you want to call it that. I personally would like to see it quiet down for a day or so. I'm not sure you're going to get a perfect setup like this, and then, come out of a little low cheat area. That would be ideal. The more that it can tighten up, to me, the better. So especially if maybe, Bitcoin pulls back here, it gaps and then it pulls back. And while that pulls back, and sets another pivot. This sets a lower pivot here, maybe lags a bit. But again, I don't know where 255 comes in, but it's
Yep.
looking like, you're trying to form this low cheat. And this is a power play type play here. 100, it's gone up 145%, and now it's only corrected from here to about 20%. So it meets all the power play criteria at this point.
Yep, Jesse, if you may want to type in. Follow-up question he did have, though, Mark, is with the name having some increased volatility, since it does track a lot of Bitcoin. I just lost his email. Oh,
Well, I'm not agreeing with increased volatility. I don't see that. Let's just start right there. This is tightening up. It's been very low volatility, so I don't understand where an increased volatility case can be made for this. So this is a very high alpha move with only a 20% give back after 145% advance. So this is actually very low volatility, especially considering it's in the Bitcoin space.
Yeah, here's the question. It was basically with a volatility in more volatile names, I guess let's just generalize it. Will Mark consider to let the stop loss level be higher than his 8% threshold
No.
because of it?
No, just the opposite, the complete opposite. Obviously, you didn't read my book, or you didn't read this section of my book. You need to go back and read my book, and read both books, because when volatility is higher, by the way, Mark, are you here?
I am here. Yeah, exactly.
So, Mark, when volatility is higher, what do we like to do?
Yeah, you got to get tighter. You don't getting wider only allows the volatility to grab hold of you, as Mark would say.
Yeah, you're playing that
Playing
game.
into its hands.
Like
Exactly.
let me give you, and then you can even take off on this, Mark, if you'd like. Let me give you an analogy. You're a boxer, and you go in there with a guy who's a brute force puncher. Do you go in and slug it out with him? You go in there and go toe to toe? No, you'll get your head knocked off, right? So you don't want to play that opponent's game, right? You would stick and move, stay away, and jab and stay out of that danger. So that's the same thing with trading. You don't want to let the volatility now. So it's a volatile situation now. So you want to give more volatility, like that. How is that helping your risk reward ratio? How is that creating asymmetric leverage? The whole idea is to in a volatile situation, you want to cut off the downside volatility. So now the upside is your alpha and the downside is cut off, and you've created asymmetric leverage. So just the opposite. When it's volatile, I want to figure out ways to cut the volatility or cut the downside portion of it and expose myself to the upside, because with volatility you're going to get stopped out more often, and so you've got to account for that. To account for that, you now have to have a better reward risk ratio. I don't know, did I leave anything out, Mark?
No, I covered it. The other analogy you use is I think the wild poker player, where you play tighter when you're, among, rather than, don't join someone in their wild behavior. You get more disciplined. And the way we're going to make up for that, because I know some of you, if you're new, are going to say, well, but won't I get the odds of me getting stopped out be higher? Well, yeah, but you've got more opportunities. It might take you 3 or 4 times. That's why you want to stay tight. If you just get wide, to Mark's point,
But
you're just letting
losses work geometrically against you. So if you're going to get stopped out more anyway, why not get stopped out more with smaller losses and give you more opportunities? If instead of only having one try at it or a couple tries, and now you take a big loss, because losses work geometrically against you. So the bigger loss you take, the more of a hole you dig yourself in, the harder it is to get out. So yes, you will get stopped out more often, but that's the whole point of it. That's the whole point of being able to get stopped out more often, and cutting off that volatility. A perfect example is me, adding to my DIA on the short side, so adding more risk, but then trading from such a tight stop that, okay, but I've cut that off. Now I've got the downside, but I've cut the upside side off of that, right? Now, yeah, that's going to stop me out more often, but that's okay because I get more tries at it. And if I'm wrong, the small losses aren't going to geometrically work against me like a large loss. It's just math. It's simple. It's pure math, and it's probabilities. Let's move on to another one. Another
All right.
question.
Donald's asking if you sorry, not Donald. I'm on the wrong person. Sorry. Question from Toby: was the last Uber trade not an extended stock with a short base?
An extended stock? No, it's not an extended stock. You've got it, but you do have a short base, absolutely. But just playing it, coming off the first tag for the 50, it should just go, set up and go. So if it doesn't, it's not ready. And is it extended on a longer term basis? Absolutely. But that's what you get when you get a stock that's got it's got the 12 out of 15 days up. I mean, the optimal buy point was over here. This is where you had that first move up. You got that first pullback, that base, and then you went into earnings. That was a beautiful trade. That's the trade we did. So this was, a secondary trade. Where if you want to call it extended, longer term, it is a bit extended, but that's okay. You can trade a second, third, fourth stage base. But as you get to those later stage bases, you want to be cognizant of that and be trading once again tighter and tighter and tighter, and then maybe just trading from a shorter term basis.
Okay. Question from Arun is asking about Dell, Dell. He bought this on a low cheat on April 1st.
Yeah. Yeah, so this isn't extended. This is one that if you see went up, and then I pointed out at an earlier time that we looked at this, how it accelerated. And then I pointed out how these, fail very often when you try to buy them from that first little base. And it shook around a bit, their volatility was there, but then finally it got its act together way over here. See, it took some time to consolidate after it had that acceleration. Same thing's happening now where you've accelerated again. Right, you've moved up here at this rate, and now you've accelerated again. I think this is, you've got a trade that, you're getting a little fortunate here on an extended stock, and I would, probably just trade this. I'd probably be out of it already, right into this first run.
Yeah, so he sold 3 days later, half of his position for a 10% gain, and letting it play out, keeping it very simple with the worst case, he will give it a 5% if it gives a tighter entry again and add to those shares back. But otherwise, he's I think moved his remaining position back.
That's a classic Minervini type play. It's just I probably again, if in a really good market, I'd probably playing this, but still just playing it for a trade more than longer term at this point.
All right. Angelo is asking about PSTG. Strong sector, strong stock, not a power play, and a short base. So he's not in it yet, but he's asking your opinion.
Another one where you see you've run up and then you've really accelerated here, and now you've got that short base. You just got to be careful with these short bases after you extend like this. They're more tradable. It's a bit volatile. I'm staying away from it, but maybe it'll work for a trade. It's not sharp enough from me at this point. This base is not crisp enough for me.
All right. Question coming from Hazem, just mentioning in reading the Mindset Secrets book, which he has applied successfully to his Batman game. He was asking, though, if you can share, Mark, how he's not applying it effectively yet to his trading. And he's heard you say that the key to trading is preparation. He screens every day. He makes his own lists and buying the same stocks you're buying, but I'm still not being profitable, and I feel I need to improve the mental part. So what mental exercises do you use for trading?
Well, first of all, preparation is the key. As far as dealing with fear, indecisiveness, preparation is the key. Being fully prepared, knowing every eventuality and having contingency plans. That really helps with your mindset quite a bit. I mean, Mark, what would you say what is the reason why, you trade pretty much effortlessly like me. You're not sitting there, well, we don't have any hair. I was going to say pulling your hair out, but you're like me. We don't have any hair to pull out. You're not sitting there like a long-tailed cat in a room of rocking chairs, worried all day. And the only thing I could think of is the reason why is that we're prepared. We kind of know our worst case scenario, our position size, where we haven't eliminated risk, but we've mitigated it to a large degree, right?
Yeah, we're managing it properly, and to the degree that it doesn't make you, mentally or emotionally, uneasy or unstable. I think the original question was about what the mindsets, right? And
Yeah, but I think that that is a big part of people being nervous and
right,
not being able to be decisive and or to go in there and buy and being worried about what's going to happen is usually stems from they haven't really figured out what the worst case scenario and planned for it ahead of time and married that with what is suitable for their risk tolerance. I go into a trade and I buy 1,000 shares and I put $1 stop. I know I risked $1,000. I mean, you know if $1,000 is acceptable risk, but knowing that, I sleep perfectly fine. At night, knowing I've got my risk covered. Now, can it gap? Sure, it could gap. So you've got to think about that too. And what's that worst case scenario? And that's where position sizing comes in. Now you say to yourself, well, I'm not willing to take X amount of loss. So this thing gap down 25%. What's that loss? What is my worst case scenario loss? And then there you position size for that. So you have your stop loss, you have your position sizing, you have your liquidity risk. We talked about risk as far as assessing, and I'm going off a little bit, and I'll come back to mindset. So just hold on a second. Assessing risk, position size, your stop loss, volatility, liquidity. These are things that are you plan for and you prepare for. Mental rehearsal, that's a big part of mindset, is mentally rehearsing how you're going to handle particular scenarios. I mentally rehearse in the morning. I mentally rehearse for everything in the morning. Like my day, I sort of think out my day. If the market is going to open down big and I've got a bunch of positions, and I start mentally rehearsing how I'm going to deal with that. um, and also just my day in general. If I have a bunch of meetings, and I sort of go through everything, and not only have a good idea of what my day entails, but then set an intention as to what's important, what's prioritized, what I need to accomplish for that day, and sort of create a priority list or a hierarchy of what I'm going to prioritize throughout the day. What else? Assigning pain and pleasure. That's a big part of the mental side. So you need to. Some people have a hard time taking losses. Um, what you need to do is realize that taking losses is part of it, and you assign pain to large losses and pleasure with small losses. That's something that I had to shift. If you read that in the mindset book, I started off thinking all losses are bad and trying to win all the time, but then I shift that and I said, you know what? If I take really small losses, I could lose a lot and still be accomplishing my goals. So I won't feel bad about losing as long as the losses are really small. So I shifted the pain pleasure principle from losses to large losses. And now when I take a small loss, like if I get stopped out today on this DIA at the high, my overweight, it means absolutely nothing, like nothing to me. Like it's just part of doing business, and it wouldn't discourage me or upset me. There'd be no emotion whatsoever. Um, Let's see what else. I think that's that's pretty much it. Is off the top of my head. I mean, there's a lot of the mindset techniques and tactics and stuff in the mindset book that you can apply, but they go to the deeper self-image and feeling deserving and power and choice and all those things that are going to make you see the opportunity in the world and the opportunity in the stock market, and stay with what you're doing for the long term, having that vision. A lot of it is about sticking with it, sticking with the process and not giving up. That's a big part of the mindset, is not getting discouraged, because we're all going to go through periods where things don't work very well. And you have to realize, if you've just been doing this for a couple of years, you have to think in 5, 10 years, not in 1 month, 2 month, or 1 or 2 years. How many things could you possibly go out there? Anything great? You want to be a great baseball player, lawyer, doctor? Are you going to be great in 2 years? No. So don't expect that in the stock market. That's the biggest part, I think, of the mindset, is thinking longer term.
All righty. Tim is asking thoughts on PNC.
PNC. Incidentally, we are working on. I've hired some really amazing people to work with me and quarterback an initiative to create a mindset workshop similar to the Master Trader program. We're anticipating that it's going to be a live workshop. It may be multiple days too, but and it will not be a stock workshop. It will be a mindset workshop of working on getting yourself to maximize your potential of your thinking to in all kinds of things from finances to relationships, business. So if you're interested in that, let us know. We'll put you on a list. We haven't officially created a list for it yet, but we are actively working on a really intense mindset workshop. So PNC, this looks really good from a little pullback here. You got a little gap. Nice little base. I don't know much about this one, but I'm going to look into it because it looks interesting. Let me see from a weekly. It looks like, yeah, it looks like, so we're just starting to turn up here. So this would be your first base in a new, potentially stage 2 uptrend. And that, that's about the earliest that I would be looking to buy a stock would be coming from a first base, maybe a low cheat or a cheat. So this, looks like you're in the initial stages here of a potential new uptrend. So I think it looks pretty good with my limited knowledge on it.
John is mentioning over the previous week, his portfolio has dropped 3% and essentially has lost 21% of his open profits from the portfolio high.
Mm-hmm.
Was this normal size give back or too large? I got stopped out of positions from around fully invested to about 50% now. Or should I be reducing more exposure?
Mark, that's an interesting. Those are giving us some, real numbers to chew on. 21%, about 20% of your profits, which equates to a 3% actual,
Portfolio.
drawdown. Yeah,
Yeah.
portfolio drawdown. Just hearing that, what are your thoughts? I'll give my thoughts too, but what are your thoughts as far as if that's normal or not?
Well, my first thought would be, what was the plan, right? What did you have in your head for your worst case scenario? It sounds like you might be, just from the tenor of the question, wondering if that was too much. And, look, based upon the worst case scenario, I would say if you're 100% invested and, a 2-3% pullback in open trade equity is not abnormal at all.
Yeah,
And if you
20% give back isn't a major either.
not of open profits, and I would actually say that's not too bad in terms of means you're probably holding some names that are holding up well. So I this is where you just have to run your worst case scenario from here. Okay, at 50%, if everything gets hit, is that too much? And this is where, Brandon and I did the same thing in the office, going, look, all right, we've given back to how much. Sometimes you just draw a line in the sand.
Yeah.
And that's where based in the environment right now, I would be more there rather than, but trying to give the strongest position still the benefit of the doubt.
Yeah, be careful, if you've been, having a lot of alpha for several months and things have been going really well, and then there's a change in character, and now you've got that drawdown. As Mark's saying, don't start drawing down more. This is where you have to, and at the risk of maybe selling out right at the low when things start turning back up, but you've got to protect yourself. You don't want to let the 20% turn into a 30, then a 40 and a 50. So you get smaller and you start pulling back your exposure and your activity, and then you rebuild back into it, slowly. But your question of whether it's normal or not, I don't think that's abnormal. But from this point on, yes, then if you start getting to a 30-40% give back, you don't want to give back half or more than half of your profits. I mean, that would be sort of the maximum, that you'd probably put a line in the sand.
Good. Torsten is mentioning or asking about MRUS.
MRUS. Yeah, I just saw that's on watch. Yeah, you've got this little base here setting up off the lows, tried to turn up here and didn't follow through. I think this is a thinner. Yeah, it's a pretty thin name. And I don't like that it's coming to the 50. That's a sign of weakness that it's actually coming all the way back and tagging the 50. So it would really have to go soon, maybe get a reversal recovery above that recent squat there, but it's very thin. So I'd be real careful with this. But certainly if it, moves up from here, can stay tight, takes out that recent reversal, I would definitely not, I would definitely set a stop, below the lows here and below the 50-day.
And TARS.
Yeah, so a little better. I think this is maybe a little better looking at. Again, I don't know this one really well, but let me see. What's this? What part of this pull? So this pulled back about 30%. So this is really just building a new base here. I don't know how much it went up here. Yeah, so you might look at this as a power play, but it came back a little excessive, but now it's going through some iterations here. I mean, it looks pretty good. Again, in a really strong market. I'm not looking just at the technicals here. I don't know anything about the company. I don't have this is one that I don't know much about. I haven't seen the earnings and the sales and the margins and so forth. So I'm just looking purely at the chart. You're definitely forming a VCP here, but it needs a little more work on the right side. And in this type of market, I'm going to be real careful with even the stocks that look the best.
Yep. Question asking Gustavo, Mark, you wrote the other day in the platform, real money and longevity is achieved through consistent compounding, which is driven by process and discipline. Could you elaborate further on the process part? What do you really mean by that? Could you give us examples?
So if you get the process right, I mean, very simply, if I give you a recipe to bake a cake, you go in and you say, okay, I need a cup of sugar, 2 cups of flour, cup of milk, put it all together, put it in the oven at 350 degrees. What comes out? If you do all that right, you get a perfect cake. Comes out, the recipe's made every time, comes out the same. So worrying about the result, the result is just a byproduct of doing the right steps. So it's no different. This is no different. It's all about just doing the right steps, taking the right steps, making quality decisions, and making every decision. I don't really look into thinking about putting this all into perspective, portfolio management and buying one stock because the other stock's down, or buying this one in this industry group because it's a hedge versus this industry group. All I do is look for stocks that meet the criteria, make quality choices. Every choice I make has a, in my mind at least, has a mathematical expectancy, positive mathematical expectancy, and I'm managing that risk per trade. And then when I put all those trades together, it builds me into a portfolio. It's going to build me into being fully invested, or 50% invested, or having 10 positions or 5 positions. That's just sticking to the rules, stock by stock, and sticking with the process. Mark, you have anything to elaborate on process driven and
Yeah, I would
not worrying too much about the results? I mean,
yeah, I think Mark talks about sometimes the process vacuum packs you or seals you from outside influence and those types of things as well, so that you don't care what other people's opinions are. You're your own operator that, is making and compounding good decisions. The other part of, I think, a process, I think of it's something you have to go through yourself and no one can do for you. So even something like grading your trades or doing the post-trade analysis. I could grade your trades for you, but the process of you doing it and seeing, oh, wow, I have this tendency, or when I really did good buys, and all of a sudden that gives you the confidence that influences your actual behavior and decisions. Like, that's part of being driven by the process itself. And then, yeah, to Mark's point, the outcome just sort of eventually takes care of itself. We say those things, but it's because the process actually, again, morphs its way into and changes you as a trader and an operator into being just more disciplined.
it takes time. It takes time. But I'll give you just an example. I was just talking about this the other day with one of my mindset coaches, and we were talking about the process of your thinking. Just the process of your thinking changed a lot for me in my shooting sport. When I first started competing, I would go up and the first thing you do is there's a timer, it beeps, and then you draw your gun as fast as you possibly can. You rip the thing out of there and you start shooting, and you're running around with this deadly pistol in your hand, shooting real live rounds. So I would start thinking, the first thing I would think is don't shoot yourself in the foot. Because if you go real fast to grab it, sometimes you grab it and you grab the trigger too quickly, and you jump on the safety and the trigger too quickly, and you have what's called an accidental discharge, and you can discharge the gun into the ground. And if some people shoot themselves, I've actually have 2 friends who shot themselves in the foot and in the leg. But that's not the way you want to think about it, because that just drives your mental energy right into shooting yourself in the foot. That's actually putting your focus on that, and that creates that. The same thing with trading, where you want to focus on the process and not the result, especially the result that you don't want to happen. So how I shift that was, I shifted my mindset, and this is thought shifting. When you do get those type of thoughts, you immediately recognize it and you thought shift. So my thought shift, and now my thinking is automatic. When I go to draw a pistol, that doesn't even come into my mind, because I've done it so many times. But my thought process is smooth, clean, nice, clean, smooth draw. Finger in the right spot, everything correct grip, and then hit the A zones. All A's. I used to also think don't miss, no mics. They call it a mic. Don't no mics. That just pushed me into mics. I don't think that way anymore. I think all A zones, all A zones. I'm going for perfect hits. And then by default I get less mics. By default, I don't shoot myself in the foot, because I'm not putting any energy into that. I'm putting my focus on drawing it properly. So get the proper steps. Now, these things happen in trading. There's a lot of little individual steps. So you've got to start working on, maybe, and this is where post-analysis comes in. You got to start worrying about, okay, I have to work on buying correctly. And then when you get that, you could start working on something else. And then you start putting all those pieces together. So there are incremental pieces that have to be worked on. And then you start building, and you have a full toolkit, and you become a competent trader. But it takes time, just like anything else.
Good. Constantine is asking or suggesting to both Marks and Brandon, if it's possible, would you be able to create a tutorial about how you use progressive exposure since the October low? I know it would be very personal based on risk preference for each individual, but if we could see a case study over the last 4 months.
The case study has nothing, it doesn't add any benefit. It's the same thing over and over and over. We could tell you in 5 seconds how we do it. We just don't have to have a case study and show you. We are showing you. We're showing you on a daily basis. You've seen positions get added to the portfolio, if you want to call it a portfolio, open positions. We don't have a model portfolio, but we do have open positions. And you've seen them expand to where, I don't know, I think we had 40 at one time, to now it's down to 10 or 12. And you've seen that in real life, real time. And the STEM model also shows you that upward easy dollar back down to the hard penny. There's nothing really to show. When you buy a stock, all right, if that stock is showing you a profit, you buy another one, and only stocks that meet the criteria. And until you've got some profits, you don't add more exposure. There's no sense in adding more exposure. If you're not profitable at 50% invested, and you've got 4 stocks, why the hell would you go and add more exposure? For what reason? To hope and pray that things turn around? Until you get some traction. And just the opposite, if you get yourself heavily invested and it starts moving against you, and now you're showing losses and you're getting stopped out, well, then you sell, and you pull back. There's not a whole lot. I know this progressive exposure is everybody's trying to get this like black and white answer. There isn't one. There isn't one. It's really a very much an art form that is fitted to your own style and your own risk tolerance. I don't know, Mark, how would you, do you think, I mean, that showing how you've applied progressive exposure is going to be any different than just explaining it in a sentence or two?
Yeah, no, and we covered this a little on Thursday, and it gave a few examples of that as well. So yeah, I mean, look, we're going to continue to do exactly what we've been doing.
I don't think I think if you can't get it, if you can't understand it with an explanation, I don't think you're going to understand it with showing a couple charts. I mean, it's really not any different. It's not that complicated that believe me, if I thought that, we would do X and it would yield to this big increase in our members doing well, of course I would do it. Absolutely. But I've been doing this for 40 years, 40 plus years. I've been training traders. I advised the traders at Soros Group. I've advised that the best in the world, and I've advised the worst in the world. I've advised members that just started and they've got a $500 in their trading account. I've gone the whole full gambit. And what I've learned what works and what doesn't work for not only trading but for training. And this is it. You just got to stay with it, and you've got to keep practicing and making mistakes, keeping them small, and you will learn. But some things we're just not able to turn on a switch and get you up to speed right away. It takes practice, and it takes over time. You'll all of a sudden you'll get epiphanies, and you'll be like, that's I see now. So you need that. You need to get in there. It's the same thing with anything. What do you think a doctor does a residency for? What do you think? Lawyers do mock trials and then work up. With anything, it takes practice. You go start off at little league, then you go and you play in high school, and then you go to college, and then you go to the major leagues, and you're a rookie, and you'll go to football. You'll be a football player. You'll sit on the bench. You'll never even see the field for a while. This is the process in anything to becoming great. The experience is a big part of it. That's why I just keep hitting home that you guys got to stay with it. If you're not getting the results that you want, it's not the system, it's not the market, it's not the opportunity. It's you. You just haven't built the skill. But I assure you, you are more than capable of doing it if you just stay with it and keep practicing the right things. We're showing you the right things.
Okay, CJ is asking what's classified as a forced trade. Any buy outside of a low cheap breakout and pullback buy. For example, GoDaddy, GDDY. If I missed the buy notice from the platform on March 12th and I placed his buy when the platform put on an ad on March 18th, would you count that as a forced trade? Thank you for your explanation.
So, Mark, I'll let you first define a forced trade, and then I will too.
Yeah, I would say a forced trade is anything, that you didn't plan on doing or buying, I guess that would be the most basic definition for me.
Right. When you deviate from your rules.
Deviate from the plan or the rules, yeah.
So, and you're doing it emotionally. Usually a forced trade means that you're doing something, it's driven by emotion. You missed it and now you're like, oh no, it's going to go. Okay, I'm going to buy it extended. I know I shouldn't be doing this, but just this one time. Or the stock rolls over, it hits your stop, but it gaps through your stop. And now instead of your 6% loss that you were planning, it's a 9%. And you're like, well, the maximum's 8. So if it comes back to 8, I'll take the 8. And then it goes down to 10 and 11, and before you know it, you're forced to take a bigger loss because you can't take the pain anymore. Those are forced decisions that you are emotionally putting yourself in a position where you get forced to make it, or the market's going up. Right? The market's going up, 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 up. There's no stocks really setting up perfectly. So you start buying stocks that aren't set up perfectly. And because you are pressured by the progress in the overall market, or because your neighbor's bragging about all the money he's making in the market, and the market's going higher, but nothing's meeting your criteria. So now you start thinking, this doesn't work anymore. Maybe it's different this time. I can break the rules here. Those are forced trades. Anything outside your plan or outside your rules, particularly if it's emotionally driven.
Gary's asking or mentioning he bought an oversized position on SLV on 4/2. Silver, April 2nd.
Yeah, hold on. I'm just gonna write something down. SLV, silver?
Yep. Bought it on 4/2. Sold a quarter of it to reduce to a full position because he bought an oversized on 4 and reduced the risk on 4/3. Holding the risk. Did I get lucky or a bad trade, or is it decent?
I wouldn't say you got lucky. I'd say that you bought 1 day late, or maybe 2 days late. I would actually start it maybe somewhere, on 328, then added on the next day here on the 4-1. I think the buy you made, you're buying it as it broke out through here when you could have got a head start on the pullback buy, and maybe not all of it. Maybe even if you bought half the position, either on 428 or a quarter of the position, then you added to it, and then on the breakout you got more aggressive as it started to confirm. But you bought the breakout, so I wouldn't say no. It's not a bad decision. You didn't. I don't think you got lucky either. I think you made you bought a base breakout, and with gold strong, you're getting now. It looks like a sympathy play. Silver's following up because gold. If you look at gold, so we broke out here. It's been 1, 2, 3, 4, 5 days or so. You see, gold broke out way earlier. So silver is actually moving up after gold's following through from this this natural reaction. And as money's starting to come in here and chase gold, it's going into other areas too, in sympathy, it looks like.
Ankit bought NAMS
NAMS.
on March 28th and got stopped out the next day.
Yeah,
Can
I
you
don't know. I don't
critique
think we
its
had
entry?
this. Yeah, I don't think we had this on focus list, but it was on my watch list because it was in a base. It was high relative strength. But I didn't really like the way this was acting and setting up. It just, and again, I point to anything in particular? This is really just my own experience. It also is very thin, I believe, right? Very thin. So with the fact that it was thin, and you had some overhead there to the left, I don't think it made a terrible trade. I just think that this is one that being so thin, you got to be real careful with. And it's a little lower priced, but yeah, keeping a tight stop on it was the right thing to do.
Yeah, that's the highlight, as you can see, continuing to go lower. So good job to get out quickly. SERA is building the base. Asking if you see
Yeah,
that.
Sierra. Yeah, I saw that also over the weekend. Close to putting this. It's a lower price than this type of market. I don't like the lower priced names, but it's really pretty tight here. So this was one that I was considering putting on focus, and then I decided to wait and see how it trades today. But this is definitely one that could be considered for focus. It's really close. So I may be putting this on focus list soon. Maybe even as soon as today. Just going to see how it acts. If it can stay quiet here, that would be great. You got a big volume here. I'm not sure what that was from. It was supportive. It did get a reversal here, but I like the way it's now tightening up right into that. And if you can come out here, you're likely to get a reversal recovery. The question is it going to follow through and hold? That's the real question. And a lot of these we're still seeing some breakouts, but they break out and then they come back in and they squat and reverse the same day or a day or two later. So very, very short term right now, those who are scalping might still be making money. But the swing trading has definitely diminished. The reward to risk has definitely come down.
All right. Keshev is mentioning in Market Wizards, Ed Thorpe and Jack Schwager say that the optimal position size would be half of the number derived from the Kelly formula. And based on his 2-year numbers, his batting average of 43%, average gain over 10, average loss 3.5. Kelly recommends his position sizing being 40%, which I feel is too large. Would love your comment on this.
So it's a kind of a complicated question. I'm not completely sure I understand the halving. Does that mean that half of what the Kelly formula would, if the Kelly formula says 50%, you should be 25%?
That's what he's saying. Ed Thorpe and Jack Schwager say.
Oh, okay. They're saying, yeah. So figure the Kelly formula and then go.
They're actually, to quote that, is they're saying don't go more than half because they think full Kelly is too aggressive based
Yeah.
upon, and there's a number of reasons for that.
I think full optimal F, which is essentially the Kelly, if they're similar, full optimal F up to 25%, I think makes sense. What I found is that for a 2-to-1 trader, 25% is optimal, and optimal F and Kelly formula will give you the same answer. So I have not, my own anecdotal evidence in doing this for the years that I've done it, have found that the Kelly formula and optimal F for a 2-to-1 trader is about right. I
Yeah,
don't
Mark,
look at
just to clarify though, I think he's speaking about meaning risk to the total account when they're talking about full Kelly. So
risk
position
of the
size.
total account. That's a whole different story. Yeah.
Exactly. Well, that's where you have to differentiate between position size versus
Yeah, I'm
risk.
talking about position sizing.
Exactly. I want to make sure
Are we
make.
talking about risk of total equity?
Well, that's where. Well, when they that's what Thorpe and Schwager are referring to is saying. Hold on, I got
Risk
some.
of total equity. I don't care what Schwager or anybody's saying. I can tell you right now, risk of total equity should be 1.5%, no more than 2.5% tops. So regardless of what the position sizing is, you back into that number. The end of story. I don't care what anybody says and what any formula says. That is the right advice.
Yeah. So let's just to recite his numbers. He's got a 43% batting average,
Yep.
average gain of 10.7%, average loss of 3.5. So phenomenal.
Right. So he's over 2-to-1. So he should be, I would say optimal F off the top of my head, optimal F and Kelly would recommend between 30 and a 40% position size.
And that's what it is. And he's saying he feels that's too large to be taking.
Right. But that's position size, Mark. That's definitely not risk of total equity. That's position sizing.
Right. So he doesn't want to take 40% position sizing. He's asking for your comments on that.
Well, I don't think taking 40 to 50% position sizing is very risky regardless. So again, I recommend you never go more than 50% invested in one position, preferably, 25, I think is the most like aggressive, prudent balance, if you will. If you're at a smaller account, it's all the same, it's all relative, but it's not necessarily, because if you've got $10,000 that you're trading and you're an American, that has a job that you're making, I don't know, a decent salary, well, you could replace that. You can recover from that. That's not the end of the world. If you're trading $10 million, you're 65 years old, and it's your life savings that you've put together for the last 40 years. That's a different story. I don't want to wake up one morning and find out I'm down $5 million. So, and half my retirement's gone. So that has to be considered. With that, all that consideration, 25% is where I see, 25 to 30% is about the max. And when you go higher than that, you really got to start thinking cushion and, liquidity. Like I would go 100% invested in the Dow, short the Dow, because I know the Dow is not going to gap up 15% on me, so there I would go with the Kelly number. However, on a smaller cap or an individual stock, I have to be much more careful. So those are the things that have to be weighed. The Kelly number, though, is going to be the right mathematical number. If you go to a horse race and but we'll put it this way: if you just have, let's stick with trading. If you know your batting average, if you know your percentage of winning trades, your average gain, what your average gain is going to be, everything else is a mathematical calculation. The math isn't going to change. All right, the math is the math.
Mark, I'm having a little issue on my computer. Oh, just coming back on. I hope you're here. I hope you hear me. Okay,
I'm hearing you, yeah.
All right, good. DW is asking if TSM is viable if it crosses 145.
Yeah, Taiwan Semiconductor. I don't think so. No, I think it's, this is too volatile over here. You've run up quite a bit. You've extended here. Yeah, I wouldn't buy it. This is a little, let me see, how much did this move up there? No, it's about 20-something%. So it's not a real blow off move. I'd want to see more tightening. Let's just put it that way. If this got really tight here and held up during a market pullback, let's say the market pulls back 4 or 5% here, and it takes a week. During that week, instead of this pulling back with the market, it does this, and then coming off the lows of the market correction, it breaks out from there and takes out the high. Then I'd look to maybe buy it. So that's what I'd like to see. It's just not price ready for me yet. Doesn't mean it can't work, but just not there yet for me.
All right. Mark Ritchie, I'll just give you the heads up if there is a problem with my computer because it's still acting.
Yeah, I'll handle the questions. Yeah.
Yeah.
Okay.
Tom is asking thoughts on Eli Lilly tightening up.
Yeah, Lily's on my watch list. you know, this is definitely one best in class, and things are going really great for Lilly fundamentally. I think you could consider this again. This is one where, you know, it's probably going to move somewhat with the market. If the market really starts to come off here, this will probably get some volatility. But if it can stay tight, especially if the market, you know, is picking up in volatility, and then maybe it comes out from here, you know, you can try it. It's again, just check the comes through here. Yeah, it's about 5-6%. We're about 9% down to this low. So I would keep it on a very tight leash. The thing right now is that if you're going to trade smaller bases and you're going to trade in this type of market where we're on red on the stem, we have a small focus list. You can see, you know, the open positions have paired way down. Volatility started to pick up. If you're going to do that, you want to cut off the volatility in the individual stocks. So buy only in the direction of your trade, right? Don't ever buy in the opposite direction. If it's pulling back, wait for it to turn up and try to trade as close to the danger point as possible, or just keep a mathematical or a dollar stop. You know, you go in here, it turns up, it starts breaking out, it's got to go. You know, use the low of the day, the previous low, the previous day's low. If it doesn't go, it engulfs, you're out. And you keep those losses maybe only 2%, 3%, as opposed to 5, 6, or 8%. And now you've baked in that higher failure rate. Now you can have a lower batting average, and your numbers are still not going to get affected. You're still going to be, you know, keeping buoyancy in your edge.
I think Bob had to
Makes sense.
restart, so I'm gonna take the next question. Question mark is, how do you handle when the Minervini buy risk and the Minervini pressure don't align?
So the buy risk would be more important than the pressure. So I'll give you the general rules of thumb. Buy risk, definitely, if it's red, that you really don't want to stay away from those. But you could be green on buy risk, and on the pressure, you could be under pressure, but you're coming off a low cheat. And off a low cheat or a cheat, you may still be red. But you want to see it turn green pretty soon. Like if you buy it, come a low cheat and say it breaks out today, you'd want to see it tomorrow, within the next day or two, a couple of days, it should turn green. That's the confirmation you'd be looking for. But when you start getting into higher pivots in the mid of the base and the handles and BCPs that are in really strong uptrends, then you prefer to have them both green. But that's sort of the caveat there.
Next question, your thoughts on CRBP?
CRBP. Yeah, so this is also, well, obviously this is on our focus list. So, you know, this is a bit volatile though. I was reluctant to put it on. It came up about 35%. So I'm looking at this as a little base here coming from a cheat. Maybe you get a trade. This is a perfect example. You see the volatility? See, it comes out, then it engulfs, it's whipping you around. So it's again, you got to be careful here with any stocks breaking out right now. We're definitely in the in the more volatile state in the market here. There's been a change in character, and when you have a stock like this that's corrected, 35% in just a few weeks, again, it's just tradable. It's probably one that I should have. Over here, this is a nice low cheat right here, right here. Again, it's pulled back quite a bit. Let's see. Yeah, see, 50%. So this has a nature of being very volatile. And so I would look to buy these off the lows, buy off a low cheat, a cheat area like this is here, and then just trade it. Because you can get a good trade when they're this volatile. They run it back to the old highs, and it's a big number. So if you can get in at a low risk, very tight, you've got the upside and you crimp off the downside. But quite frankly, this is probably one that we shouldn't really have on focus. It's a bit too volatile. I put it on. It's the one flyer that I have on there.
Another question on FIX. Your thoughts?
Yeah, so this has come a ways. We were looking at this a long time ago. I think way back here. As a matter of fact, I believe we bought it right here. Yeah, I think these were the buys right here. Or here, and then added it here. And I think this volatility might have knocked us out at break even. I can't remember, but if my memory serves me, then it got into trouble for a little bit. And since then, this was your next, viable point right here where it based. It was sort of not completely symmetrical, and then a nice run. So you're getting extended here. You're getting an acceleration, and I pointed this out before. See, if you look at this rate of acceleration, you're running up at this rate, right? And now you've accelerated that rate of advance. So you got to be careful when you come a long way and then you accelerate, and that acceleration, you go and you measure it. This is when you can go to O'Neill's. You go to my books too. I talk about some of this, but O'Neill talks about the blow off moves. This stock has moved up 65%. Let's get a weekly. Let's take a look here. So this stock moved up right here. We'll call it about 60% in 1, 2, 3, 4, 5, 6 weeks. That's a climax blow off move. That's you sell into that. So I would not buy here. And if anything, I would only short-term trade it to the upside. And this is because you've made a big move, and now see here you've accelerated the rate of advance. So you're getting very late stage here. At least near term, this kind of action can stall the stock out for a while.
Andrew's asking about IBIT today, wondering about financing the risk because things haven't been working as well.
All right, I'm going to let you answer that. What do you think with that, Mark?
Well, you could. You certainly
the IBIT guy.
Yeah, well, I don't know the IBIT guy.
The Bitcoin guy.
Well, listen, you could. What type of trader are you? If you want to play it for a bigger move, we just sort of started the position. I'm hoping we stall here and we can add to it.
Look, that's the conservative play. You have to decide. Do you want to be greedy? Or, and I don't even call it greedy. Do you want to risk it or not? It's your choice. There is no right answer. It's either you take the safe play. Now, are you going to regret it afterwards? When you take the safe play, it goes higher and you're going to be all upset. If that's the case, then that answers your question, but the thing is most traders are upset either way. If they take half of it off and then it goes higher, they're upset. And if they hold it and it goes down, they wish they took half off, and they never can win. And there's the mindset side. You can't be thinking that way of Monday morning quarterbacking. You go in, you have a plan, you make a decision. This is what I'm risking. This is what I'm willing to risk for this reward. And you go with that. And that's your play. That's your play. It's your play. You can, as long as you're doing, forget about taking the risk as far as off here. This was a good risk reward play when there was no gain. It was already I wouldn't be taking a trade if it wasn't. So now you can give yourself a guarantee, a virtual guarantee. I like guarantees myself. So I've built a fortune on taking the conservative route.
Absolutely. Renee's saying that she likes to stack rank the focus list every week. I'm not 100% sure. Maybe that's a poker term, Mark. You could what that means.
Rank.
But she's curious if you do rankings throughout the day or week, and would you share the descriptions or types of categories?
The only thing I do once it hits the focus list, I look at them in basically just a couple different ways. One, they either have fundamentals or they don't, and the ones that don't, if they're biotechs, I can understand that. And I rank them in as far as the quality of the setup. Focus lists will have setups on there that aren't yet set up to the point where the quality is good enough where they're immediately buyable, but there's enough there that they could be buyable within a week. That's generally what I'm looking at, is that within a week they could be buyable. So each day I'm just looking for what's buyable. It's David Ryan does the same thing. Mark and Brandon do the same thing. We're interested in that right side, and what's happening on that right side. Is it immediately buyable right now? Because that's all that matters. Today, what can I buy today? If there's nothing to buy, okay, fine. Then next thing is what am I selling? At a profit or stocks that aren't acting right. So each day is what am I buying and selling? And for the focus list, it's all about whether it's buyable or not, because it's already met enough criteria. To get on focus list, it's already in an uptrend. It's already met a bunch of criteria.
Michael's asking about GWRE, if it's a cheat. or a solid cheat?
GWRE. Haven't heard that name in a while. Yeah, I don't know much about this. It's come a little bit of a distance. Let's see. Yeah, so you made a big trip down, a big trip up. Well, actually, this trip up is from 50. It's not that big. It's only about a double. I mean, it's definitely a cheat. There's no doubt about that. It's borderline low cheat. So it's definitely a cheat, but I don't know much about this at the current moment. So I'm gonna have to look into it. And if I like it, I'll put it on focus list, and you'll know, I blessed it. But again, it doesn't mean it can't work, even if I didn't bless it.
Matt's asking more personal questions, saying he just lost his father recently. Our sympathies, Matt.
Sorry to hear that.
Sorry to hear that. I'm wondering what's helped you overcome personal grief.
I can relate to that because I lost my father when I was 26, and it was sudden, out of nowhere. And my father was like Superman to me. So it was the biggest shock to my system in my entire life. So I mean, I was very upset for quite a while. I talk about this in my mindset book. I was very upset, and I realized that feeling was really eating me alive, and I had to change it. So I just started dedicating my life and to my dad, and just decided that I'm going to do what I have to do to to make my dad proud of me, and sort of use that energy to fuel me. And in honor of my father, I accomplished a lot of things. So it's about shifting the meaning. Shifting what does that mean to you? Does it mean that your life's over? Same thing. Tony Robbins talks about. Your wife does something, cheats on you or something, and you break up. You can look at it as this ruined my life and life is over, or you can look at it as good thing it happened now. I can now go find the person that I'm supposed to be with, and same event, but different perspective on it, and what you're going to do with that thing. I'll tell you right now about my father and death is that this is the one thing about death that I've realized is that no matter what you do, that person's not coming back. And that's what I had to come to grips with. That I one day I got up and I said, you know what? It doesn't matter what I think. This person's not coming back. So that's what I have to deal with now. Now it's really in my hands. Like it has nothing to do with that person anymore. It's all about me and how I think about that and what I do with that. So and that's how I dealt with it. I had my most success after my father died, and I felt the most crippled. But then I felt liberated once I made that shift in perspective. We got to run though, because I have a small meeting that I have to go into in a couple minutes here. I think at 12:45 actually. So I hope this has been helpful today. Mark and Brandon will have a Q&A on Thursday, of course, as usual. Like I said, just take it easy here. Things have definitely taken a change in character. There's not a lot of ideas. It's very easy to start forcing things and trying to make something out of something that's not there. I call them the last of the Mohican trade. Sometimes when the market's entering a correction, you get these few last setups, and they're the last ones before everything breaks. They suck you in, and you lose money from the volatility and the reversals. So maybe some go up and you miss a few, but you want to be trading aggressively when the wind is in your sails, not when the wind's coming in your face. And right now, we definitely got a headwind. There's no doubt that we have a headwind, and we need to see it shift first before we get aggressive. Anything Mark?
No, I think that sums it up well. So it's a good session.
Okay. All right, guys. We'll talk to you. Monitor the platform. I hope this has been helpful. See you guys later. Thanks, Mark.